Hello, and welcome back to the Fintech Takes podcast. Today we have a very different episode for you, a little experiment, if you will. I have been told by folks in the Fintech Takes audience from time to time that while they really enjoy my written content, sometimes it's a little too long to sit down and actually read at your desk. Not everyone has the time to do that, but a lot of people have time to listen to podcasts on their drive home from work, while walking the dog, while working out. That may be where you're listening to me right now. And the idea was maybe we could take some of the written content we've created at Fintech Takes, particularly some of the longer content, the stuff that I'm really proud of, that a lot of research was poured in, and turn that into a podcast episode. So that's what we're going to try to do in today's episode. This will essentially be the audiobook equivalent of a newsletter that I wrote a while back. We published at the end of June called Why Is This Happening? An exhaustive review of the history and nascent culture of the CFPB. So here's what's going to happen. I am going to read that essay end to end in case you haven't read it or you haven't revisited it for a while. And then at the very end of this podcast, I will jump back in with some contemporaneous updated thoughts on what's changed since I published this article and what my viewpoint on the CFPB is as of the middle of August. So if you have any thoughts or any feedback on this episode or its structure, I would love to hear it. But without further ado, here is the audio version of my essay, Why Is This Happening? Why is this happening? An exhaustive review of the history and nascent culture of the CFPB. Here's the question. Would the Consumer Financial Protection Bureau still be getting aggressively hollowed out by Trump administration officials and Republicans in Congress if the agency had been run differently over the last 14 years? It's entirely possible that the answer to this question is yes. As one source I spoke to for this story colorfully described it, it's just random chance that the CFPB was the one that ended up trapped in Russ Vogt's torture dungeon. This is a valid perspective. Vogt's war against the federal bureaucracy isn't specific to financial services or consumer protection regulations. It's wide-ranging and framed in the broadest and most existential terms possible. Here's just one quote from Project 2025, which Vogt helped write. The overall situation is constitutionally dire, unsustainably expensive, and in urgent need of repair. Nothing less than the survival of self-governance in America is at stake. Now, that's obviously much bigger than Elizabeth Warren or Rohit Chopra. In an alternate universe, an alternate Russ Vogt is probably working to functionally eliminate the U.S. Department of Agriculture, the Nuclear Regulatory Commission, or some other equally useless patch of the bureaucratic swamp. That said, most of the folks I spoke to for this story didn't feel like it was entirely random that the CFPB became the poster child for the Trump administration's war against government overreach. They felt that there was something specific to the CFPB, its mission, how it was founded, how it had been operated over the last 14 years, that made it an especially tempting target. Now, I tend to agree with this, and I think it's an important idea to interrogate. Most federal financial services regulatory agencies are really old. The Federal Deposit Insurance Corporation, or FDIC, is 92. The Federal Reserve is 111. The Office of the Comptroller of the Currency, the OCC, was founded during the Civil War. It's 162 years old. Now, the reason this matters is that these agencies have been around long enough to establish institutional cultures that persist across different political climates. Now, to be clear, this isn't always a good thing. These agencies can be a bit old-fashioned and stuck in their ways when it comes to adapting to innovation and new technologies. And occasionally, the cultural problems at these agencies are much, much worse, as the situation at the FDIC over the last couple of years has demonstrated. That said, I think the stability, predictability, and apolitical nature of most federal financial services regulatory agencies is mostly a feature, not a bug. As I have written about previously, financial services companies benefit from certainty. Executives at these companies want to know, within a reasonable margin of error, that the rules today will be the rules tomorrow, and next year, and 5 years from now. Even if the specifics change, they want to feel confident that regulators will show fidelity to the underlying principles: safety and soundness, fair competition, consumer protection, regardless of their politics. So even though stories like that one that the Wall Street Journal reported on about the OCC fighting over a portrait of the first comptroller of the currency with the Treasury Department are a little silly, and they definitely are silly. You should really read that article if you haven't gotten a chance. They're also a symptom of a more profound feature of a well-designed government system: institutional trust. Broadly speaking, people trust that the FDIC, Fed, and OCC will be around for a long time, and that they will continue to do their various jobs, ensuring safety and soundness, most importantly, and in a mostly fair and unbiased manner. Institutional trust is why serious and pragmatic policymakers such as Mickey Bowman, Jonathan Gould, Rodney Hood, and Travis Hill have been appointed to leadership positions at these regulatory agencies. It's why the Supreme Court took the unusual and legally questionable step of telling President Trump not to fuck with Jerome Powell. And I believe a lack of institutional trust, which is broadly an epidemic in our society today, is why Jonathan McKernan ultimately backed away from the chance to run the CFPB. So, in today's essay, I'm going to examine the history of the CFPB and the attempts made over that time to establish an institutional culture that would outlast our current political epoch. This essay is based on interviews with more than 24 former employees of the CFPB, whose tenures collectively cover the last 14 years, and whom I granted anonymity so they would feel comfortable sharing their insights and experiences with me. Defining the CFPB. Before we delve into the last 14 years, we should set the stage by reviewing the origins and statutory authority of the CFPB. The CFPB was created by Title 10 of the Dodd-Frank Wall Street Reform and Consumer Protection Act in July 2010. It was the brainchild of Elizabeth Warren, who was, at the time, a law professor at Harvard. As the financial markets were melting down in 2007, Professor Warren was pitching her idea for a new federal agency focused on making consumer financial products safer. And I quote, "Consumers can enter the market to buy physical products confident that they won't be tricked into buying exploding toasters and other unreasonably dangerous products. They can concentrate their shopping efforts in other directions, helping to drive a competitive market that keeps costs low and encourages innovation in convenience, durability, and style. Consumers entering the market to buy financial products should enjoy the same protection. Just as the Consumer Product Safety Commission protects buyers of goods and supports a competitive market, we need the same for consumers of financial products. A new regulatory regime, and even a new regulatory body, to protect consumers who use credit cards, home mortgages, car loans, and a host of other products." Notice how Warren couches her proposal in the language of capitalism. Safety standards, like those created by the CPSC, create a more efficient and competitive free market, such that the commission authoring and enforcing those standards essentially pays for itself. Here's Warren again. "The evidence clearly shows that CPSC is a cost-effective agency. Since it was established, product-related death and injury rates in the United States have decreased substantially. The CPSC estimates that just 3 safety standards for 3 products alone, cigarette lighters, cribs, and baby walkers, saved more than $2 billion annually. The annual estimated savings is more than the CPSC's total cumulative budget since its inception." Warren goes on to propose a financial product safety commission that would centrally regulate the safety of financial products rather than financial institutions, thus reducing the incentives for regulatory arbitrage. This FPSC would act as a highly technocratic translation layer between the financial industry and consumers. Here's Warren one final time. An FPSC would promote the benefits of free markets by assuring that consumers can enter credit markets with confidence, that the products they purchase meet minimum safety standards. No one expects every customer to become an engineer to buy a toaster that doesn't burst into flames, or analyze complex diagrams to buy an infant car seat that doesn't collapse on impact. By the same reasoning, no customer should be forced to read the fine print in 30-plus page credit card contracts to determine whether the company claims it can seize property paid for with the credit card or raise the interest rate by more than 20 points if the customer gets into a dispute with the water company. Instead, an FPSC would develop precisely such expertise in consumer financial products. A commission would be able to collect data about which financial products are least understood, what kinds of disclosures are most effective, and which products are most likely to result in consumer default. Free of legislative micromanaging, it could develop nuanced regulatory responses. Some terms might be banned altogether, while others might be permitted only with clearer disclosure. A commission might promote uniform disclosures that make it easier to compare products from one issuer to another, and to discern conflicts of interest on the part of a mortgage broker or seller of a currently loosely regulated financial product. This vision, along with the tremendous amount of lobbying from Warren and others, resulted in the creation of the CFPB, which was charged by Congress to, and I quote, implement and, where applicable, enforce federal consumer financial law consistently for the purpose of ensuring that all consumers have access to markets for consumer financial products and services, and that markets for consumer financial products and services are fair, transparent, and competitive. End quote. It consolidated consumer protection authority from 7 different regulatory agencies and 18 enumerated consumer laws into one single agency. It established a rather unique organizational structure and funding mechanism. A single independent director with a 5-year term and the ability to draw up to 12% of the Federal Reserve System's 2009 operating budget, inflation adjusted, each year. And it defined the structure of the Bureau and the scope of its authority. Banks, thrifts, and credit unions with more than $10 billion in assets would be directly supervised, along with non-banks in the mortgage, payday lending, private student loan, and other larger participant markets. The Bureau itself was organized in the following divisions, along with separate offices for the General Counsel and External Affairs. Supervision, Enforcement, and Fair Lending, which was responsible for examinations, investigations, and litigation. Research, Markets, and Regulations, responsible for rulemaking, market studies, and data analytics. Consumer Education and Engagement, responsible for financial education and vulnerable population outreach. Operations, responsible for HR, tech, security, finance, and until 2014, managing the Consumer Complaints Portal. Treasury Secretary Timothy Geithner named Warren assistant to the president and special advisor to the secretary and tasked her with building the agency. She and her initial team, including Raj Date, Len Kennedy, and Peggy Twahig, drafted the first org chart, designed the Consumer Complaint Portal, and interviewed more than 2,000 stakeholders. Warren was viewed as the logical choice to lead the agency as its first director. However, fierce opposition from the banking industry and Senate Republicans scuttled that plan, and instead, former Ohio Attorney General Richard Cordray, whom Warren had already hired as the CFPB's enforcement chief, was appointed to be the director instead. The Cordray era. The best summary I have heard of the rich Cordray era of the CFPB, particularly the first 2 years, was messy and messianic. Let's start with messy. The Bureau was brand new. It had to be staffed up rapidly, which was accomplished through a combination of bringing in outside folks from industry, consumer advocacy groups, and state regulatory agencies, as well as a lot of transfers of federal regulators from other agencies, such as the Fed, OCC, and FTC. In those days, the CFPB didn't have a single headquarters. Staff were dispersed across a number of old office buildings in DC, all of which were, I should say, in dire need of refurbishment. Cockroaches were a common sight, according to multiple sources. To put it into fintech terms, the CFPB in these days was an early-stage startup. There were no processes in place. Everything needed to be figured out on the fly. Early hires were given a great deal of responsibility and autonomy, which they eagerly embraced out of a sincere desire to help consumers. And that brings us to Messianic. The early CFPB was intensely mission-driven. Recruiting was, in the words of an early leader at the Bureau, like pushing on an open door. In the wake of the subprime mortgage meltdown and millions of Americans losing their homes, people were deeply passionate about the idea of joining an agency expressly designed to protect consumers. A well-known mantra inside the Bureau in those days was, no one should lose their home, their savings, or their dream because they got trapped by a fine print trick. When asked to describe the culture of the CFPB in those days, an early staffer I spoke with described three main pillars. The first was anti-capture. The first wave of the CFPB staff in 2010 and 2011 moved into the office of the former Thrift Office of Supervision, or OTS. Their headquarters were at 1700 G Street Northwest. OTS was created in 1989 to supervise thrifts following the savings and loan crisis, but it quickly gained a reputation for being excessively industry-friendly in its pursuit of assessment fees from the institutions that it supervised. It would constantly brag about its focus on deregulation and regulatory flexibility. There's a famous picture of a former director of OTS holding a chainsaw at an event that was focused on deregulation, which, in the spirit of everything rhymes, really reminded me of Elon Musk several decades later doing the same thing. The OTS was eliminated by Dodd-Frank after its deregulatory zeal specifically contributed to the failures of high-profile institutions such as Washington Mutual and IndyMac. Working inside the corpse of a regulatory agency that had failed due to industry capture gave early CFPB employees a visceral reminder of the importance of staying aligned with consumers' interests and not becoming too cozy with industry. The second pillar was pro-competition. The Bureau was explicitly created to encourage fair competition. The core idea, as expressed in the Warren article that I already quoted, is that free markets produce the best outcomes for consumers, but only when those markets are fair and transparent. One of the primary purposes of the CFPB was to level the playing field and increase choice for consumers. This impulse, in some ways, tempered the Bureau's anti-industry capture philosophy, which, if left unchecked, could easily evolve into a broader opposition to capitalism. Finally, the third pillar was a wide-angle lens. Unlike the NCUA, the OCC, and others, the CFPB has no chartering authority. As such, its purview isn't limited to a particular segment of the banking industry. In fact, one of the primary motivations behind the creation of the CFPB, as expressed in Warren's article, was to have a cop on the beat who could monitor non-bank financial services providers and other innovative, less regulated corners of the industry. This mandate created a culture of curiosity inside the Bureau, with staffers, particularly those in the Research, Markets, and Regulations division, constantly trying to understand where the industry was headed. I can tell you from personal experience dealing with the folks in that side of the Bureau, they were always very curious and had a ton of questions about what was happening in the industry and how it was evolving. This culture was designed to optimize for two different and at times contradictory outcomes. The first was to put wins on the board. There was a strong desire and an urgency during the early days of the CFPB to demonstrate the value that the agency could deliver to consumers. Part of this urgency was statutory. Dodd-Frank mandated the creation of certain regulatory rules within specific timeframes, mostly in the mortgage space. And then part of it was a desire on the part of the leadership in those days to show that the agency was focused exclusively on consumer protection and could generate a tangible ROI, meaning the number of complaints handled, the dollars redistributed back to consumers, and so forth. The second objective, which again was somewhat in tension with the first, was to build a great institution. Balancing out the desire to rack up those quick wins was this recognition that the Bureau needed to wield its broad authority judiciously. Early leaders at the Bureau took the Federal Trade Commission as a cautionary tale in this respect. I'm not sure how many listening know this, but prior to the 1980s, the FTC had a broad mandate and very few checks on its authority. However, after attempting to impose an expansive ban on television advertising targeting children, the FTC created a massive backlash for itself, which resulted in the agency's authority being severely curtailed by Congress. Recognizing the possibility that their expansive powers and political independence could be similarly curtailed if they overreached, Cordray and his staff sought to maintain what they called paradoxical conservatism that kept the Bureau employees' passion and enthusiasm balanced against the cautious use of the Bureau's authority. Beyond these structural considerations and organizational incentives, much of the early CFPB's culture was a reflection of Rich Cordray himself. In my discussions with those who worked with him, Cordray was consistently described as smart. He was a 5-time Jeopardy champion in 1987. Pretty fantastic piece of trivia. And prepared. He always read the prep memos before meetings, including the footnotes in those memos. This created a highly inclusive environment with weekly policy committee meetings featuring stakeholders across all divisions and recurring pitch-rich days where staffers were encouraged to pitch in their crazy ideas. This environment was appreciated and resented roughly in equal measure. Staff felt like they had a seat at the table and the ability to influence policy, which is hugely appealing within bureaucratic environments, especially to staffers who are newer in their careers. However, the consensus-driven environment was also a source of frustration, especially among folks in the Research Markets and Regulations division who felt that their subject matter expertise should be given more deference in the decision-making process. The large group meetings were also a venue for an important ongoing debate within the Bureau at the time. Which tool should we use? As anyone who's ever worked for a bank or fintech company over the last 14 years can attest, the CFPB has numerous ways to advance its primary policy goal of protecting consumers. It can write rules, bring enforcement actions, and prioritize various topics within its supervision, research, market outreach, consumer education, and external affairs initiatives. Put simply, the Bureau has a lot of different clubs in its bag. And because Dodd-Frank authorized the CFPB to stop unfair, deceptive, or abusive acts or practices, also known as UDAP, in connection with any consumer finance product or service, it was able to go further than other regulators and consumer protection regulations had gone before. In fact, no other federal statute had ever banned abusive conduct, and Congress gave the CFPB the sole authority to flesh out what that term means in the context of its responsibilities. Now, for the most part, the Cordray-era CFPB attempted to be thoughtful in selecting the appropriate tool for each job. And when it selected the hammer, i.e. enforcement actions, it generally tried not to swing it in an overly reckless or aggressive way. However, it wasn't always successful. When I asked folks for examples of cases where the CFPB had overstepped in those days, the same one from this era consistently came up: PHH Corp versus the CFPB. In 2014, the CFPB brought a case against PHH, alleging that the company had steered borrowers to mortgage insurers that then bought captive reinsurance from a PHH affiliate in violation of RESPA. The controversy was over how the CFPB chose to implement and interpret RESPA in this case, which included claiming every premium paid into a captive deal is an illegal kickback regardless of market value, which discarded established regulatory guidance that had been allowing such deals if they were priced fairly, and applying that reading retroactively back to 2008, declaring basically that there was no statute of limitations in the CFPB's administrative actions, and significantly increasing the penalty that was assessed to PHH. This aggressive interpretation was rejected by the Federal Appellate Court for D.C., with Judge Brett Kavanaugh calling the CFPB's approach an abuse of discretion, and finding that the CFPB's single director structure was unconstitutional. Much of the appellate court's ruling was later overturned, but the case created a beachhead for future legal challenges to the Bureau's structure and funding, and dragged the case out long enough to see it dismissed by the first Trump administration. It also provided fodder to critics of the CFPB inside the banking lobby and on the Republican side of the aisle on Capitol Hill, who saw the Bureau as inherently hostile to the financial industry, which was a position that was much more palatable to take after we were a few years removed from 2007-2008. Director Cordray resigned in November of 2017, almost exactly a year after the election of Donald Trump. This brings us to the second era of the CFPB, which we need to split into two eras, as a matter of fact. The first is the Mick Mulvaney era. No one I spoke with for this essay had much to say about Mick Mulvaney. His tenure as acting director of the CFPB was dramatic but brief, roughly from November 2017 to December 2018. There was a fight with Cordray's former chief of staff for interim control of the Bureau. There was Mulvaney's first day, which included bringing in donuts to the staff, as well as imposing a 30-day freeze on hiring, new regulations, guidance, and civil penalty fund payouts. There was his absolutely bizarre and unsuccessful attempt to rebrand the CFPB as the Bureau of Consumer Financial Protection, which would have cost the CFPB $19 million and the industry an additional $300 million in compliance costs if it had been implemented. Most importantly, for our purposes, his leadership style marked a sharp break from the Cordray years. More reliance on political appointees and less on advisory boards, significantly less access for rank-and-file staff, decisions announced by directive or press release. This, of course, set the stage for Kathy Kraninger, who was confirmed as the new full-time director of the CFPB in December of 2018. CFPB staff from this era remember Kraninger first and foremost as an institutionalist. While not the inveterate financial services policy nerd that Cordray was, she wasn't reading the footnotes, Kraninger was seen as open-minded and accessible to staff and often willing to defer to their expertise. She reinstituted all-hands meetings and town halls, but took a more streamlined approach to rulemaking and enforcement than Cordray had, which isn't necessarily a bad thing. Given her appointment by President Trump, it shouldn't be surprising that Kraninger was more friendly to the industry. Under her leadership, the CFPB pared back several rules. It also introduced additional efforts to encourage innovation, like no action letters, sandboxes, tech sprints. This isn't to say that rulemaking and enforcement stopped, however. While Kraninger took a more methodical and data-driven approach, new rules were still written on her watch during these years. The debt collection rule was the big one, and enforcement actions were still broad, although there were fewer than in the Cordray years, and they tended to avoid novel UDAP interpretations. It's also worth noting from the Kraninger era, the Supreme Court case Celia Law versus the CFPB, in which 5 of the justices, including the CFPB's old friend Brett Kavanaugh, who is now on the Supreme Court, found that the structure of the Bureau, specifically its single director who could only be removed from office for cause, was unconstitutional. This ruling altered the incentives for future directors, starting with Rohit Chopra, who took over from Kraninger after she stepped down at President Biden's request in January of 2021. The Chopra era. Before we get into the details of the Chopra era, which ran from October 2021 to February 2025, it's worth setting the context here. By the time he took over the Bureau, a decade after it officially opened its doors, the environment had changed in several important ways. First, the CFPB director could now be fired, as we were just talking about, thanks to the Celia Law decision. This essentially put a 4-year political clock on all work being done by the Bureau, which naturally incentivized Chopra, and will, one imagines, incentivize future directors, to advance policy objectives using the most expedient means possible. Second, by 2021, the tech industry, both fintech startups and big tech companies like Apple, was playing a much more prominent role in the financial services ecosystem than it had been in 2011. This change mirrored a broader shift in society's feelings about the tech industry over that time period, which evolved from being largely positive to decidedly mixed, particularly among progressive politicians and policy folks, many of whom ended up embedded throughout the Biden administration. Third, and finally, it's worth reminding ourselves that the banks and fintech companies have always complained about the CFPB, stretching back to its earliest days. Under Cordray, the criticism was that the Bureau was drafting too many rules, when what the industry really needed was more flexible, less prescriptive guidance. Under Chopra, the CFPB did precisely that, focusing more on guidance and less on formal rulemaking. And, surprise, surprise, industry continued to complain, saying that they needed certainty of rules, not vague and unhelpful guidance. This is the curse of being a regulator, and it's helpful to remember if you want to properly contextualize the Chopra era. Now, having said all of that, the feedback I got from the sources I spoke to for this story, who again span every era of the CFPB in a wide range of seniority levels and divisions, did not paint a flattering picture of the Chopra years. From a process perspective, the comparison I heard most frequently for Chopra was Mick Mulvaney. A heavy reliance on political appointees rather than career staff, and an insular command and control model for policymaking that bore little resemblance to the exuberant collaboration of the Cordray years. From a policy perspective, Chopra was, as one source described it, what Republicans in the banking lobby caricatured Richard Cordray as: aggressive, ideological, and broadly untrusting of corporations. The effect of his approach can best be described using those three original pillars of the CFPB's culture, which I had described before. Anti-capture. One of the chief complaints about the Chopra era was the Bureau's leadership team was so focused on avoiding being captured by industry that it ended up being captured by consumer advocacy groups. Organizations like the National Consumer Law Center and the Center for Responsible Lending wielded enormous influence over the CFPB during the Biden administration. Pro-competition. Under Chopra, the CFPB replaced the Cranager-era no-action letters and sandbox initiatives with an Office of Competition and Innovation, which focused more on the structural barriers to competition in markets like AI, data portability, etc., aligning with the Biden administration's overarching focus on antitrust issues, which is a very different approach to encouraging competition. And then finally, a wide-angle lens. Another complaint of the Chopra era was the Bureau went much further than it had under prior directors, and arguably further than Congress intended, in expanding the perimeter of the CFPB's supervision and enforcement authority. The most obvious example of this was Chopra's focus on big tech companies and non-bank payments and digital wallet providers. However, the Bureau's interest in the finance-adjacent corners of the market extended even further, including forays into video games and airline reward programs, which were areas that I criticized when they were happening at the moment. The Chopra-era CFPB was also notable for its heavy reliance on novel or overly aggressive strategies to influence the direction of the market beyond rulemaking and enforcement actions, both of which, it should be noted, surged back to Cordray-level highs. These included the use of circulars and interpretive rules, giving the CFPB's opinion on how existing rules and statutes should be interpreted without requiring a formal and rigorous rulemaking process, as well as new transparency initiatives such as the Public Registry for Repeat Offenders, which critics argued were simply a way to shame financial services companies into taking the actions that the Bureau had no legal authority to require. One illustrative example of the latter strategy, which came up a few times in my conversation with sources, was the press release announcing a proposed settlement with LendUp, which the Bureau had brought multiple enforcement actions against over the prior 5 years. The announcement mentioned LendUp's venture capital investors by name in the subtitle and the text of the release, despite those firms not being mentioned anywhere else in the actual legal complaint. I'll read the headline and the subheader just so you can hear it. CFPB shutters lending by VC-backed fintech for violating agency order. Subtitle: Google Ventures, Andreessen Horowitz, Kleiner Perkins, and other prominent venture capital firms invested in LendUp. I will tell you, this decision upset the fintech VC and startup community, obviously, but it also perturbed career staff at the CFPB, who were accustomed to operating with a stricter duty of care in these instances. And this brings us to the vote era. The Chopra era ended, as we all knew it would, on February 1st, 2025, when President Trump fired him and appointed Treasury Secretary Scott Bessent as acting director of the CFPB. 1 week later, repeating the playbook he used in 2017 with Mick Mulvaney, President Trump reassigned Russell Vought, director of the Office of Management and Budget, to serve as acting director of the CFPB. Since then, the following things have happened. Vought instructed staff to pause virtually all work being done at the Bureau, including exams, investigations, rulemakings, and even press releases. The White House nominated FDIC board member Jonathan McKernan to be the permanent director of the CFPB, but subsequently withdrew the nomination. The Bureau paused, postponed, rescinded, vacated, or otherwise backed away from a multitude of Chopra-era rules and proposals, including open banking, small business data collection, credit card late fees, and overdraft fees. The Bureau dropped or moved to withdraw nearly 24 pending enforcement actions, including high-profile suits against EWS and Credit Acceptance Corp. Vought proposed barring the civil penalty fund from financing consumer education projects, limiting it to direct restitution. Vought is actively working to reduce the CFPB workforce from 1,700 to about 200 core statutory employees. And Republicans in the House of Representatives are attempting to reduce the cap on the CFPB's funding mechanism by 50%. Which brings us right back to where we started. Why is this happening? If there's a definitive answer to this question, I think it can be derived from the words of Mark Andreessen, which is not a sentence I was ever hoping to have to say out loud in my entire career. When Andreessen appeared on the Joe Rogan Experience back in November of last year, he went out of his way to talk about the CFPB. Quote, "This thing called the Consumer Financial Protection Bureau, which is Elizabeth Warren's personal agency that she gets to control, and it's an independent agency that it just gets to run and do whatever it wants. It terrorizes financial institutions, prevents new competition, new startups that want to compete with the big banks by terrorizing anybody who tries to do anything new in financial services. This is where a lot of the debanking comes from. Under current banking regulations, after all the reforms of the last 20 years, there's now a category called a politically exposed person. And if you are a PEP, you are required by financial regulators to kick them off your bank." Now, as many observers, including myself, pointed out at the time, that second paragraph of the quote is complete nonsense. However, the first paragraph is worth careful examination. Let me repeat it. The CFPB is Elizabeth Warren's personal agency that she gets to control. It's an independent agency that she gets to do whatever she wants with. It prevents new competition, new startups that want to compete with big banks by terrorizing anybody who tries to do anything new in financial services. If you could hop in a time machine, go back to 2010 and ask them, these are not the quotes that Elizabeth Warren, Raj Date, Rich Cordray, and the other founders and early employees of the CFPB would have wanted to be said about the Bureau in 2024. Their goal and Dodd-Frank's statutory mandate for the CFPB was to be seen as a positive and powerful force for new competition. It was for the CFPB to be seen genuinely, not in air quotes, as a credible, independent agency that can't just do whatever it wants and isn't secretly under Elizabeth Warren's control. In short, their goal was to create an agency that Mark Andreessen and other disruptors in financial services would appreciate, and in an ideal world, be protective of. Bankers were always going to, mostly, hate the CFPB. Consumer advocates were always going to, mostly, love the CFPB. The swing vote, the one that would indicate whether the CFPB had successfully built and maintained a culture of consensus, compromise, and paradoxical conservatism, was the tech industry. Sometime over the last 14 years, the CFPB lost that swing vote. It lost a big part of its institutional trust and credibility. And given the rising levels of political polarization and the sustained assault that we're seeing on the concept of regulatory independence, it may never get them back. Okay, well, that was my essay, Why Is This Happening? Which I hope you enjoyed the audio version of. To wrap up the podcast, I wanted to just spend a couple of minutes editorializing a little bit about what I've learned since the piece was published, what I heard from folks after they read it, what the CFPB has been doing since I published this piece, and what those actions tell us about the future of the Bureau. First, I will say that the feedback I got on this piece was very positive for the most part. Unsurprisingly, I didn't hear from the Bureau directly, the current CFPB, but I did hear from a lot of employees, both current employees and former employees, who broadly confirmed that what I had heard from all of the sources I spoke to for the piece was generally pretty accurate. There was a sense that somewhere along the way, particularly during the Mulvaney period, very briefly, and then more so during the Chopra era, that the CFPB just kind of lost its way a little bit. And that the original culture of the CFPB, which was intended to be sort of rigorously and independently pro-consumer, and was intended to be very focused on driving more competition, was lost and became sort of suborned by other political objectives, some of which were incentivized by the Celia Law decision and other changes that happened, but some of it was just choices that were made, right? And the thing I thought a lot about while I was writing the piece, and then certainly after it as well, is this idea that, the structures that we have, the government that we have, the regulatory agencies that we have, they don't happen by accident, right? Nor do they happen by destiny, as if some grand design was written and everything was supposed to play out the way that it did. They happen based on choices. right? Choices that human beings make. And it was really interesting talking to people for this piece, finding out that a lot of the things that ended up being kind of critical decision points or decision paths in the history of the CFPB were in the moment decisions where it really wasn't clear what the right direction to go was, right? I spoke to someone who said even a decision that the Bureau made that turned out to work out really well and strengthened the culture and the approach of the CFPB and created a really strong precedent for other consumer protection actions to follow it. Even that decision that worked out well, the person I was speaking to said, that could have gone the other way. And if it had, it really would have been damaging to the CFPB, right? A lot of these choices are not evident in the moment, but with the benefit of hindsight, clearly sort of paint a picture of what has happened and where things are going. Obviously, that brings us to the CFPB today. And as I outlined at the end of that piece, the vote era CFPB has really been an exercise in almost like performance art for what can we do to shrink government down to the absolute smallest size possible. And most of the CFPB's actions have been very consistent with that goal, right? They've been cutting staff. They've been asking for less budget than they've used in the past. They have been rescinding rules. They've been asking the court to vacate rules that have been the subject of lawsuits from the industry. They have even dropped enforcement actions, ongoing enforcement actions or cases against even kind of very, very obvious targets, some of which I would assume this current CFPB under the Trump administration would be in favor of, right? They've dropped cases against financial institutions that have been accused of UDAP violations against military service members, which is supposed to be one of the few groups that's still getting protected by this CFPB. So a lot of the efforts of the vote era CFPB, I think, can squarely be put in the column of we just want to reduce federal bureaucracy as much as possible. And as I said at the beginning of the essay, the CFPB has just been chosen, for whatever reason, as kind of the subject of this little experiment or this performance art piece. However, having said that, we have also seen the CFPB do some fairly surprising things. And I want to talk about two of them really fast, right? One is it's flip-flopping on open banking, right? So I've recapped the history here a few times in the newsletter. I'll do it real quickly right now. The CFPB under Chopra, under Biden, publishes the final open banking rule in October of last year. Then, fast forward from there, the banking lobby, the Bank Policy Institute, sues the CFPB over the rule. Then, fast forward a little bit more, the vote era CFPB goes to the court and says, you know what, we actually agree with the Bank Policy Institute that the rule overstepped the CFPB's authority, and we are asking the court to just vacate the rule and get rid of it entirely. Then JP Morgan Chase, infamously, introduced very aggressive pricing for use of its open banking APIs, so aggressive, in fact, that it surprised the few employees who are still left at the CFPB and motivated the CFPB's leadership, possibly with the encouragement of the tech VC crypto community, which got involved in the lobbying, to push back, which resulted in the CFPB going back to the court, flip-flopping its original position and saying, instead of vacating the rule, we would like you to pause this lawsuit while we initiate an accelerated rulemaking process to make changes to the rule to address industry concerns without getting rid of it entirely. I honestly have no idea how to read that. As I've talked about multiple times in the newsletter, it is wildly surprising. Everyone I've talked to is shocked that the CFPB flip-flopped on that. And I think it does indicate that while the Bureau is generally trying to be relatively hands-off and is generally trying to shrink the impact that the CFPB has on the industry overall, it is not going to allow any one group of industry participants, particularly a large bank like Chase, let's be honest, which is not exactly well aligned with sort of a populist administration. It's not going to allow the industry to hurl wildly off the cliff based on participants acting aggressively or overusing their market power. And I really think that the CFPB's decision here was a reaction to basically Chase saying, look, we get it. We understand you want to be able to charge for the data, but this is too much. We can't do this. And so now my understanding is the advanced notice of potential rulemaking, that's going to come out soon. It's going to ask industry for a lot of feedback. They've already been meeting with different industry stakeholders. And from what I hear, everything is on the table. Charging for data is on the table. Changes to secondary data use are on the table. Changes to liability frameworks are on the table. Everything is being revisited. And we'll see if the CFPB can really do all of that work while still hopefully trying to pursue its mission, I suppose, of being able to cut staff and cut funding. I don't really see how those two things are compatible with each other, but we'll see what happens. The second action, which I also have written a little bit about in the newsletter, is the CFPB's efforts to compensate and make whole the victims of the Synapse disaster. So if you've been following along in banking as a service, you know Synapse went through bankruptcy. As a part of that whole process, a bunch of end customers' funds got stuck or potentially got siphoned away to various places that we don't know. It looks really unlikely in the process of that bankruptcy proceeding that customers' funds will be returned to them. The Synapse estate is essentially out of money. And so instead, the CFPB has stepped in and said, you know what, we might actually bring an action against Synapse for UDAP violations in order to use our civil penalty fund, the same fund that Russell Vogt doesn't want to use for hardly anything, to compensate the victims and to get them their money back. This is really surprising on a number of levels. It does fit with the sort of populist leanings of this administration. But on the flip side, as Jason Mikula at Fintech Business Weekly, who's done fantastic reporting on the story, has pointed out, it also is a pretty novel use of the CFPB's UDAP authority. They want to bring an action potentially against Synapse for treating consumers unfairly, but Synapse isn't a consumer-facing institution, so it's a little outside of the CFPB's authority. And if Evolve Bank and Trust, who was the primary bank behind Synapse and its primary bank partner, it has less than $10 billion in assets. So it's also not within the CFPB's direct scope of authority. So it's a pretty novel and unusual way to get at this problem, which is ironic because, of course, Republicans and the Trump administration and Russell Vogt have criticized the prior CFPB for its novel use of its authority and for regulation via enforcement. So I guess the end takeaway for the Bureau is we can expect probably another 4 years of ideological and philosophical inconsistency, likely a very shrunk down and reduced agency, but one that is still used from time to time to express particular policy goals or preferences of the administration or of certain parts of the industry. We will see ultimately what that does to the institution of the CFPB over a longer time period, what it might look like under a new administration that comes back, if we'll see it whipsaw back to something similar to what we saw under the Biden administration, or if perhaps we will see the CFPB take a more measured approach to how it interacts with industry so that it can get back to building that institutional trust, which again was the primary goal of the architects of the CFPB in the early days of the Bureau. So with that, I will let you all go. Thank you so much for this, listening to this experimental edition of the Fintech Takes podcast. We'll be back at it next week.